Sergio, Ermotti, great to have you with us on Bloomberg. Looks like a very comfortable beat on the numbers. Profit 1.3 billion. What was the highlight of the quarter for you?
Well, I think we had very strong performance in our wealth management business and also particularly on our investment bank. But if you look at asset management on a reported basis and also our personal and corporate, they all contributed to a very strong quarter. And the fact that for the first 6 months of the year, we generated almost 3 billion of capital, which is a record. If you look at since the implementation of Basel III, is a record of capital generation, which allowed us to buy back, 550 million of shares this quarter, accrue for a growing dividend for the year, and also put aside for our capital requirements.
Well, you've done the share buyback target for 2018. The natural question is, will you continue with share buybacks in the back half? Are we still on target for the committed level of 2 billion?
Well, I think that it will very much depend on the outlook for business. Can we, our clients asking for capital commitments, can we deploy this capital in different ways? Is the business outlook, but also the macroeconomic outlook will play a role, and we will assess the situation during the year.
Looks like everything's going splendidly at the investment bank, looking at the rates business, looking at the FX business. Just how strong a quarter was that, and can that momentum continue?
If you look at our performance in FX, you have to look at the base. Q2 17 was a very weak quarter in terms of volatility. You remember was quite challenging. So in the second quarter this year, we had a more normalized environment, but also we had the effect of gaining market share because of our rolling out of our electronic execution engines, and I'm very pleased with the performance of our IB and particularly the FX and FRC businesses. Was
there any consequential market share won as a result of dislocation around the other investment banks?
No, I don't think it's. I don't think I would capture a thing. The competitive landscape is quite full and diverse, so I think it's not one or two players that makes a big difference if they slow down.
Talk to me about the clients. Are they taking a bit of cover? It's been a fairly volatile 6-7 weeks. Is there a sense of deleveraging from the clients?
There is. I think if you look in general, particularly when I looking at U.S. clients as a proxy to answer your question, it's quite interesting because they are still quite constructive about the future. So in terms of how they see the economy, the outlook. But if you look at their asset allocation, particularly on stocks, it's quite stable. And most importantly, if you measure compared to the third quarter of 17 till today, they had an increase of cash balances of 5% from to around mid-20s. So it's quite interesting to see that they are constructive, but on the other hand, they are not really moving their portfolios a lot. They are quite focused on maintaining their positions, and so which is not good for transactions, and they are increasing their cash balances.
Net new money is a debit item. So the market is going to want to understand from you, is this a one-off anomaly? I know you break it down, but you set some targets on net new money. This is going to disconcert the market today. Yeah. So talk me through your thinking on it.
Well, I think that if you look at, first of all, I have to say that we are reiterating that we believe we're going to achieve our 2 to 4% target for the year. We were not going into big victory laps with a fantastic first quarter on net new money. This quarter had some seasonality effect. The tax outflows in the U.S. were expected. We had a one-off outflows from a corporate that transferred their employee stock option plan, which is an interesting business, but it's a low-margin business. We had almost no effect on leverage, on lending, so clients are very cautious. But we also had a very good signal of a good momentum. Same store financial advisor net new money was up threefold compared to last year. Outside the U.S., we had almost 6 billion of net new money. So overall, I'm still positive about our developments, and we don't look at net new money on a quarter-to-quarter basis. And I'm quite confident that the rest of the year is going to be okay.
Larry Fink, we caught up with him on his results. He said if we go to a fully exploded trade war between the United States and China, quoted markets could come down by 10 to 15%. What is the Ermotti call on the consequence of perhaps an explosion of these trade wars?
Well, look, if you look at the performance of the market last year was up 20% or more. So I think at the end of the day, 10-15% correction is in the cards and can happen anytime. I do see also...
Could a trade war trigger that kind of correction?
I think it doesn't needs to be a war. It just needs to be a constant escalation, and there is also potentially a physiological need for the markets to correct, and I think it's in the card. We believe that these tensions eventually will be resolved, but our view is that things can get worse before they get better.
Page 2 of this release talks about a gradual increase in interest rates in the United States of America. Just how critically important is that the Fed stays the course for interest income for your bank?
Well, I would say for every bank is important. Having said that, we do still see all the rates hike coming in this year, and the real dilemma is to see how much you can really. The margins pressure is still there. The competitive landscape on deposits has increased in the last few years, and so the beta component on how much you retain on P&L is going to go the wrong way for us. But we're still going to be able to keep at least around 50% of the benefits of any rate increase in the future.
How's the business in Asia? I mean, we've seen this shakedown in the Shanghai Composite. We've seen some recovery, but there has been a shake in emerging markets and in China. What is the consequence for your business, or has there been a consequence for your business and client appetite?
I think that we do see, if you look at the transaction lines, has been the negative developments on a year-on-year basis was driven by what we mentioned before on the U.S. Clients being more prudent in how they invest, but also in Asia. We had a slowdown in client activity, and was somehow compensated by the MSCI inclusion of Chinese stocks, which we had a very good momentum in the IB in terms of facilitating these inflows. But in general, I would say that the environment has been more on the prudent side in Q2.
Now, the big business challenge is obviously combining Wealth America with wealth management. We've written the story. The market is definitely in a show me phase. They want some kind of number to hang their hook on. So try not to bat me back on this, but where are you with that, and what kind of synergies are possibly attainable in this?
I mentioned a few times, honestly, I think by now people should understand that this was a natural evolution of our business. The question was always why they were separated and not why we are putting them together. This is a growth story. And of course, when you combine an operation, you're going to find ways to optimize resources and work on the cost side. But the underlying motivation for us is to find a way to serve even better our client base, opening up, for example, our global U.S. capabilities to our global clients, opening up in a post-FATCA and automatic exchange of information. We are now able to serve our U.S. persons clients in a different way, in a way that it before was almost difficult or if not impossible from a regulatory standpoint of view to do. So we are opening up an avenue to serve better GFO clients, ultra clients, by working together with the investment bank, and so on. So I think that it's very much a growth story for us going forward, where we're going to be able to, offer to our clients the value of our global franchises.
To close, what concerns you the most about the next 6 months, the next year of doing business with the rich, with the wealthy clients of the world?
Well, it's still the same. It's still the same issues we have been repeating for the last few quarters, unfortunately, and they play out to be somehow then the truth of what's happening is this potential danger of trade war tensions, geopolitical events, cyclical downturn in the economy, a spike in inflation, unexpected or rate hikes that could destabilize the world. and growth, which we don't see in the imminent future. But the danger is always there, and we need to get some of these themes resolved before we can move to the next level of client confidence and in a more positive way.